Good morning, good morning. It is now 9 a.m. and I am going to call this meeting to order. If I can have all your lovely conversations come to a shh. Thank you. I would like to call this meeting to order. Thank you for joining us during our weekly hybrid MLS breakfast meetings. My name is Sylvia Ramos and I am your March program chair. This is the third week, so one more week and we'll finish March. Going to move on to Sylvia Ramos, a little bit about Sylvia Ramos. I'm going to continue the little micro bit. Alongside my partner, my life partner, I co-manage Coldwell Banker Dynasty in Temple City, where we maintain great harmony and develop agents to achieve their potential in their business family grounded in heart, harmony, integrity, and growth. As a proud member of West San Gabriel Valley Realtors, and I'm going to end right there. Thank you. And we will continue. Oh, that's so sweet. Thank you so much. Help me welcome Robert Isozaki, Special Assistant from the Public Affairs Los Angeles County Assessor's Office. Let's give him a round of applause to welcome up to the podium.
My name is Robert Isozaki. I'm a Special Assistant at the Assessor's Office. So thank you for having me here today. I'm here to talk a little bit about what our office does in general, and then also about some special programs that we have or are working on right now. So whenever I give these presentations, I like to give you a good idea of where we're going. So I go through a quick roadmap. We're going to talk about our office in general. Then we're going to kind of get into the meat of the presentation. Proposition 19, which some of you may have heard of. What happens when a property owner passes away, what their obligations are. Disaster relief, something that's very important right now. So we'll touch on that a good amount. And then finally, we'll close out on an assessor program called our e-services account. So this first portion, the overview, I like to call it the who, what, where, when, why, and how of LA County property taxation. So it'll give you a good idea of how everything works. And so we'll start with the who. Next slide, please. So there are a number of different departments that are involved in the taxation system in LA County. Each plays a kind of different role, a small piece of the puzzle. I like to give this this particular overview because say you have a client, they come to you, they say my tax bill's gone up since last year. This will kind of give you a good idea of letting them know which part of the process resulted in this tax increase so you can contact the right agency. So there's the Registrar Recorder's Office. Of course, you know them. They record deeds and other property transfer documents. Building and safety departments. When you're going to do an addition or new construction in your property, you take out permits. Either of these agencies, once they've come up with documentation, they send copies to our office, the assessor's office. We take those documents and we determine what the value of the property is going to be for tax purposes. Once we've come up with that value, we send it along to another office. It's called the auditor controller. They take those property values, apply the appropriate tax rates, add on any special or direct assessments, take all of that aggregated information and send it to the tax collector's office. They put it on a bill, send it out, and collect all of the payments. So what is it that we value at the assessor's office? What are we responsible for assessing? So real property, that's what all of you are familiar with, residential, single-family residences, condos, commercial, industrial property. We're also responsible for assessing something called business personal property. That's furniture, equipment, machinery, things that business owners use to run their businesses. You'll see on the screen here, though, a couple of kind of rarer species of personal property, boats, airplanes, and you guys are kind of close to Santa Anita over here, so you know that even racehorses can be business personal property. Next slide. So why do we do all this valuation? It's to put together what we call the annual assessment roll. Essentially, it's a list or an inventory of all taxable property in the county, and it serves a couple of important purposes. It gives local government offices a good idea of how they should budget for the upcoming year. It also gives our office a good idea of how we need to allocate our resources, both staff and programs, for the upcoming fiscal year. Next slide, please. So a couple numbers related to last year, 2024's assessment roll. The roll for the first time exceeded $2 trillion. So what that translates to as far as county revenue is $20 billion. So that's $20 billion that goes to schools, emergency services, other vital public services that we all rely on. So each year since the Great Recession, it's been increasing and we hope to see that continue. Next slide, please. So what's Proposition 13? This is kind of the foundational law in property taxation in California. It basically says when you purchase a piece of property we establish your tax base. Generally, that's going to be the purchase price, not always, but most of the time. Each year after that, your tax base is increased by a maximum of 2%. So even though from year to year, you will see your taxes go up incrementally, you shouldn't see massive dips and spikes. So this introduces a level of reliability, predictability. So from year to year, you can kind of budget for your taxes. Now, there are certain events that can occur that will pull you out of that, what we call Proposition 13 protection. One is when there's a change in ownership. So something all of you are familiar with, sales, other types of transfers of the property, and then also when there's new construction. So we'll talk about changes in ownership first, because that has to do with Proposition 19. So Proposition 19 was a new law that was passed by California voters in 2020. It came into effect in early 2021, and it made changes to two pre-existing property tax savings programs. So the first had to do with certain qualifying homeowners and their ability to sell their original property, purchase a replacement property, and transfer that original home's tax base over to their replacement property. So the qualifying homeowners are seniors, so people over the age of 55, property owners with disabilities, and significantly right now, victims of natural disasters. And we'll go through that in a second here. It also downsized certain benefits that were available for transfers between parents and children and grandparents and grandchildren. So we'll get to that in a minute here too. So I call this whole package the good, the bad, and the ugly, and you'll see why here in a second. But we'll start with the good. So base year value transfers. What did Proposition 19 do to change the old law? So under the old law, you could only purchase a replacement property in about 1 of 10 participating counties and transfer your tax base over. Now you can buy anywhere in California and transfer your tax base. Under the old law, you could do it 1 time. Now you can do it up to 3 times. This third bullet point is what I regard as the largest expansion. So under the old law, you had to purchase a replacement property that was of equal or lesser value to the home that you sold. If it was $1 over, unfortunately, you were going to be out of luck. Under Proposition 19, you can purchase a replacement property of any value and transfer your tax base over. The only caveat is if you upgrade, you purchase something that's more expensive, we're going to take the difference between your purchase price and your sales price, take that difference and add it on top of the tax base that you move over. Finally, not a change under Proposition 19, but there is a timeline. You have to sell your original property and purchase your replacement property within 2 years of one another to qualify for this benefit. This doesn't seem to be much of a problem. Most people are buying and selling within a couple of weeks to a couple of months of when they sell. So not generally something that people have to worry about, but since it's a hard and fast requirement, I always like to bring it up. Now we're on to the bad and the ugly here, and you'll see why. So this pertains to transfers between parents and children and grandparents and grandchildren. We'll just talk in terms of parent to child transfers. Under the old law, Prop 58-193, if you are a parent transferring property to your child, you could transfer your principal residence, it didn't matter its value, $10,000, $10 million, to your child without any reassessment. In addition, there was a $1 million allowance for other properties. So if you had a vacation home, rental property, you could transfer that to your children without a reassessment up to $1 million. Now, this program, Proposition 19, only applies to the principal residence. If you transfer those other types of property to your children, vacation homes, rental properties, those will be reassessed at market value as of the date of the transfer. There are a couple new additional requirements that did not exist before. For a child who receives mom and dad's property to keep mom and dad's tax base, they have to move in and file a homeowner's exemption claim within 1 year of the transfer. So whether that be a deed transfer, we use date of recording. If it's an inheritance situation, we'll use the date of death. Finally, we have questions of how long do I have to live in the property to keep mom and dad's tax base? Proposition 19 says, as long as you want to keep that tax base, you have to live there. So if at some later point, after you've moved in, kept mom and dad's tax base, you decide to buy a separate property and move out, when you move out of mom and dad's property, you're going to cancel your homeowner's exemption claim for that property. And at that point in time, we will take the market value as of mom and dad's date of death, trend it forward in accordance with Proposition 13, that 2% per year, and drop it in as of the move out date. So a lot of bad news. Yeah, there's a little bit more. So Like I said earlier, under Proposition 58, 193, didn't matter what the value of mom, dad's home was as of their date of death or the parent-child transfer, children could receive that property without a reassessment. Proposition 13 or Proposition 19 introduced what we call the $1 million value cap. Essentially, the rule of thumb is if on the date of the parent-child transfer, the market value of that property is $1 million or less, same rules apply as before. Child can inherit mom and dad's tax base without any upward adjustment. However, if the market value is over $1 million, we get into this value comparison test. And what it says is the child is going to move forward with one of two values, whichever is greater. It's going to be mom and dad's tax base prior to the parent-child transfer, or the market value less $1 million. So whichever is greater, that's what's going to be the kid's new tax base. Next slide, please. So we've gone through a lot of information, a lot of calculations. So to make things easy, we put together a dedicated Proposition 19 webpage. Has a lot of helpful information, everything that we've been over under general information, fact sheets. So if your clients have questions about this or they're looking at taking advantage of either of these programs, you can print them out or download them, email them, mail them. Very helpful. Some frequently asked questions, all the forms that they'll need to apply for these programs. And what I think is the most helpful planning tool is these Proposition 19 calculators. We have one for parent-child transfers. We have one for the tax-based transfer program. Essentially, all you have to do is know the parcel number or street address for the property in question and some market value information. You'll hit estimate, and that'll give you an idea of what the homeowner's new tax base would be moving forward if they took advantage of either of these programs. So a related topic. So a lot of these parent-child transfers that we were talking about in connection with Proposition 19, they have to do with situations where mom and dad pass away and the child inherits the property. But what we're going to talk about here, death of a property owner, applies to all situations in which the property owner passes away. So there is a requirement under California tax law that says when a property owner passes away, the assessor's office is supposed to be notified within 150 days of the date of death. And the way that one would go about notifying us is completing and filing a change of ownership statement, death of real property owner. So the person that's responsible for the decedent's estate, whether that be a trustee, executor, administrator, surviving trustee, surviving spouse, children, whoever's responsible should fill out this form, mail it in with a copy of the death certificate. If there's a trust involved, a copy of the trust, send all that into our office. What that allows us to do is update our ownership records and determine whether or not a reassessment of the property is required. It doesn't matter how the property is held. So if it's held in a trust, if the property owner had a will, didn't have a will, they're going through probate, this document should be provided to us, whatever the case may be. So a common thing that we hear is, so we find out about a date of death, we go ahead and reassess, and we get a call, maybe from the child, maybe from some representative of the property. The trust, they'll say there was no change in ownership. The property was owned by the trust before mom and dad passed away. It's still owned by the trust. Title never changed. So for property tax purposes, a trust does not own property. It's just a manner in which an owner holds title to property. So generally, mom, dad hold their property through their trust while they're alive. They own the property just through their trust. When they pass away, of course, they no longer can own the property. It's going to be the beneficiaries, normally the children, who become the owners of the property. So if we find out about that date of death and title never changes out of the trust, we will still go ahead and reassess, unless, again, there's a special circumstance like a parent-child transfer for which a Proposition 19 claim has been filed. So prompt reporting is very important. And the reason for this is if you don't report it to us and you think you're getting away with something because we're not reassessing you now, right then, if we find out about it later, we have the ability to look back in time, reassess, and you can get up to 8 years of back tax bills. So a common situation we'll see is someone not out of ill will, children, mom, dad pass away, children inherit a piece of property, they keep it for a couple of years under the trust, and then they decide to sell it. They record an affidavit, death of trustee, which lets us know mom and dad passed away. And then they record the deed transferring it to the buyer. When we get that affidavit, death of trustee, we're going to find out mom and dad passed away, reassess as of mom and dad's date of death. Depending on how many years back it went, Again, it could be up to up to 8 years of back tax bills that they can get. Generally, all those bills are sent all at once. They're often due all at the same time. And if you have mom and dad who purchased way back in the 70s and they passed away in 2022, 2023, that tax increase for each bill is going to be quite substantial. Multiply that by 8, it could be devastating. So that's why it's very important that this be timely reported to us. Also, this particular circumstance may be cropping up in the in the wildfire recovery efforts. So a lot of people are filing for specific fire relief benefits. We're finding out that, oh, maybe the person who's applying for this benefit is not the same person who's on title. Maybe mom and dad owned the property way back when they passed away. Children never changed title. We never found out about a change in ownership that would result in a reassessment. We're not evil. We're not out to get people. So what we're telling you is, if you have a client or you're in one of these circumstances, come talk to our ownership division, find out what the ownership of the property is so that you can determine how best to cure title if that's going to be the case. Next slide, please. So how does Proposition 19 and a death of a property owner come together? So we'll go through an example. And so after this, we're going to get to disaster relief, but how are we looking on time? Do we hit? Okay. How do these two topics interplay? So an example, parents own a piece of property, they transfer it to their revocable living trust. They pass away and their children are named as the trustees, successor trustees, and beneficiaries under the trust. They don't change title though. They don't pull it out of the trust. Property remains in the trust. So what should the children do? First off, they should let us know that there has been a change in ownership of the property. So they'll file the change of ownership statement, death of real property owner, along with mom and dad's death certificate. That will let us know that there has been a change in ownership of the property. We need to update our ownership records and possibly reassess. Now, if they want to keep in mom and dad's taxes, there's going to be some additional steps. Proposition 19 comes into play. They'll have to move into the property within 1 year. If there's multiple children that inherited the property, only one has to move in. Proposition 19 was not designed as an involuntary or forced family reunification process. So after they've moved in and they're also going to want to file for the homeowner's exemption claim or a disabled veterans exemption claim if that applies. And then finally, they're going to want to fill out their Proposition 19 claim form. And again, provide a copy of the trust if that's involved. So what I would recommend is fill out, last slide, please. Yeah, thank you. Fill out this document, complete these documents, send them all in at once. That way we have a global picture of the situation. If you just send in this first, we're going to see that there was a change in ownership. We don't know that you're necessarily going to apply for this. If you send it all in together, we know what you're saying is mom and dad passed away. I got the property. I want to keep their tax base. So please review all of this at once. So hopefully that will prevent a reassessment and kind of undoing of that reassessment process when we get this. Okay, next slide, please. Thank you. Misfortune and calamity. We'll get to questions at the end, but misfortune and calamity. So this has to do with disaster relief. So if you have a property that was damaged or destroyed by a wildfire, and this applies more broadly to any type of disaster, you can file for what's called misfortune and calamity. And basically what this allows us to do is review your property, determine the extent of damage, and reduce the assessed value of your property, the value upon which you're taxed, based on the amount of the damage. So the two qualifying things are the damage has to amount to at least $10,000 or more. So if your property was burnt down in a fire, you're easily going to meet this requirement. Also, within 12 months of the date of damage, you'll file an application for reassessment of property damaged or destroyed by misfortune and calamity. You're basically going to say property was destroyed or my garage burned down. You're going to provide some contact information so we can reach out to you if we have any questions about the damage. And once we receive that, we'll evaluate the property and apply an appropriate reduction. So we have a dedicated disaster relief page. This has all the information on that, as well as Proposition 19, and not only applies to people who are 55 and older or disabled, but if your home has been destroyed or damaged as a result of a governor declared disaster, you can sell that property and transfer your tax base to a replacement property. So we've tried to make this easy because we know a lot of folks are not going to have access to a printer. So you can fill out your misfortune and calamity claim online. That'll come to our assessor's office email address. You'll get an automatic reply letting you know that we received it. We are working our way through this claim, so if you don't get a response right away, please go ahead and just please be patient with us. We'll get back to you. This last slide has a couple other resources. The one thing that I just want to talk about real quick before we finish up here is the rebuilding process. We have a lot of folks who are already looking at rebuilding, and they want to know how much can I rebuild without being reassessed. So there's a lot of numbers floating around, 110%, 120. What we use at the assessor's office is substantial equivalent. So basically, if you had a 3 and 2, 1,200 square foot home, if you rebuild a 3 and 2, 1,200 square foot home, when you complete that and we take your reduced misfortune and calamity reduced property value, and we will reinstate your old tax base without an upward adjustment. So if you start adding things on, whatever the addition is, we'll value at market value, and we'll go ahead and add that on top of your old tax base. But I know we're running out of time, but we want to get to some questions. This is the email address for a disaster relief. The last couple slides here are just some general information about the assessor's office. We can fast forward a couple, please. So this is the last thing I'll go over here before we get to some questions. So this real estate toolkit has answers to questions of everything that we've been over here and commonly asked questions that we receive. So we're always happy to take your calls and emails, but if you just have a quick question or want to direct your clients to a helpful resource, this is kind of a good one-stop shop. But I know we want to get to some questions here, so that finishes up my prepared remarks, but thank you again for having us. Always happy to come out. Thank you.
I have a question up here. You may want to adjust the mic. Great, thank you.
Thank you. Very good presentation. I do have a question for clarification on Prop 19, the generation. I have been told that that generation has to be directly to the child and cannot skip the child and go directly to the grandchild. Is that accurate?
Yes, that is correct. So if you have a transfer between grandparent and grandchild, if you have a transfer between a grandparent and grandchild, the middle generation, the parents of that child or grandchild, and who are also the children of that grandparent, they have to have predeceased that transfer. So it has to be essentially a direct transfer.
Okay. And I still question the fact of the change of ownership on the deceased. That if you have a trust and that trust is in existence,
Yes.
and that person who has taken over, be it child or not child, is a successor trustee, and that trust stays in. What gives the county the right to say that it's not a separate entity?
So trust documents under the law are not separate entities. They are just they're best viewed as a lens through which ownership is viewed. So a person is considered the owner of the property. So when mom and dad are alive, they own the property. The trust is just a set of instructions on how property held under that trust is supposed to be managed. When they pass away, of course, they can't own it anymore. The children become the owners of the property if they're named as the beneficiaries. And so at that point in time, the date of death, when that transfer happens, that's when we have the authority to reassess. So that's under state law.
Good morning. Thank you. This question comes from our Zoom friends from Una G. Where do you get the ownership title?
Okay, so the way that we determine ownership for our for property tax purposes is, like I was saying at the beginning, when you record a deed, that goes to the registrar recorder's office. That goes to the registrar recorder's office. They send us copies, and we use those copies of the deeds to determine title.
Question, if you file an affidavit death of a trustee, do you still have to do the PCOR for the death? Do you still have to do that separately to inform about the death?
Yeah, so there is a separate requirement under the law aside from the affidavit death of trustee. That change of ownership statement that we were talking about, that's not recorded. It's sent directly to the assessor's office.
So you need to do both then?
Yes, they're kind of parallel tracks.
Good morning. For the change of ownership and other purposes, how do you determine the fair market value?
So our appraisers, when there's a transfer of some kind, they'll look at comparable sales in and around the area. So if you had a 3 and 2 that sold, generally, again, if our appraisers have a good idea of what the market is in a general area. So if they see that the purchase price kind of matches up with their understanding, then they'll be able to accept it. But say, for example, you have a transfer that looks like it's kind of a sweetheart deal. They'll have to determine whether or not that meets the market in that area. So they'll look at comparable sales for similar properties in that area around the time of that sale.
Sorry. So the follow-up, because when you look at sales, do you also look at say some of the sweet deals for private transfers? Do you consider those, or you just kind of skip it?
So
for
the private
comparables?
transfers, those will be more suspect. So generally, we won't be using those sales prices as part of the sales comparison approach. We'll use market, arm's length transactions, things that were on the IMLS as, actual sales situation, not kind of private transfers. Yeah.
Well, good morning.
Morning.
I do have a couple of questions. One is if somebody files a living trust
Mhm.
and both parents die, how can the people, the children,
Mhm.
the beneficiaries find out about what to do? Because a lot of times, like you said, 3-4 years, they think they're doing the right thing and they don't know exactly the process to do certain things to protect themselves.
Right. And unfortunately, there is no easy answer to that because, again, we try to come out to these types of functions, get the word out in as many forms as we can about this particular requirement and reporting. But unfortunately, and as you may know, the assessor's office is not the sexiest government office. So talking about property taxes is not, also when people are dealing with loss, taxes are the last thing on their mind. One of the programs that we have implemented to kind of get this information out there in the most kind of streamlined fashion is we've partnered with a lot of the mortuaries and funeral homes within LA County. So when people go to arrange, their funeral arrangements for their loved ones, these funeral homes can provide copies of what we call our Death of Real Property Owner packet. It has information on what to do when a property owner passes away, along with all the Proposition 19 parent-child transfer documentation we talked about.
Thank you. And the next question is, if the person owns, let's say, part of the beneficiary owns an investment property,
Mhm.
now they passed away, would that property, they say the children now decide to sell it. So, okay, we're going to sell it. Will that be reassessed at that point to the market value than the parents had, or because that would be a tremendous, from 90,000 to $1 million now. So
Sure.
that reassessment could be a tremendous.
Yeah, sure. So in that situation, mom and dad hold a piece of commercial property in their trust or major income property in their trust. They pass away. And the children, because it's not their principal residence, there's no Proposition 19 relief. So it will be reassessed as of the date of death. And so the children or whoever's responsible for the trust will be on the hook for that increase between when mom and dad pass away and whenever they sell it. And then of course, when they sell it, it'll be reassessed at market value again but that will apply to the new owner. But
Not the beneficiary.
correct.
Okay, great.
Good morning, Robert.
Morning. Mhm.
Very informative, Robert. Thank you, and very timely, your information. I work for a title company, and I get asked a lot of tax assessors questions.
Sure.
One, I just want you to clarify and verify a question that was asked was for the transfer tax base 55 years or older,
Yes.
which falls under 19.
Mhm.
The owner bought the replacement property first and 2 months ago moved in and now is going to sell her original property.
Yes.
You can do it in reverse as long as you do it within the 2 years.
That's correct. The
Okay.
one thing that's important to note is if you purchase your replacement property first and sell your original home second, both transactions have to have occurred before we can transfer your tax base over. So what's going to happen in that case is for those
Yes.
2 months, they're going to be charged for based on their purchase price.
Okay.
And then when they sell their original property, we'll be able to take their original home's tax base and drop it in as of that date for their replacement property.
That
So-
makes sense, and that's good to know. And I would imagine when you sell the original, when you do it in reverse, you have to close escrow within the 2-year period.
Correct.
Okay, and another question I got, and I have 2 files like this, is when properties in the trust, parents trust, both parents are deceased. The successor trustee, one of the daughter's sibling, is buying her other siblings out, who are all beneficiaries. Will that still qualify for the transfer tax base. Again, mom, dad's trust,
Right.
both deceased. The successor trustee daughter is going to buy the
Sure.
property and buy out her brothers and sisters.
Yeah.
How does the tax assessor view that?
Yeah, sure. So there is guidance from the state agency that regulates property taxation, the Board of Equalization. And so common scenario, the most significant asset in any estate is most of the time going to be mom, dad's home. And there's not generally an equalized amount of cash or liquidatable assets.
Okay.
And so when one child wants to buy out the other, it depends on the circumstance as to whether or not we're going to have to reassess based on one child buying out the other child's interest, which is a sibling to sibling transaction, not a parent child transaction. But BOE says if the trust takes out a loan against the property, the trustee has to do it, not the child in their individual capacity. And they are able to inject cash into the estate so that, say, $1 million home goes to one child and $1 million in cash goes to the other, part of that cash being the loan proceeds, then we won't have to go ahead and reassess. But if, say, for example, you have daughter A takes out a loan in her own name to pay off daughter B, that's not going to work. So that's going to be a reassessable event when it goes to daughter B 100%.
Got it.
Yeah.
Thank you for your time,
Yeah,
Robert.
sure thing.
Thank you.
Yes, my question is that step parents qualify for the Proposition 19
Yes.
or any restriction, or I mean, the age of the kids is under 18 or any age?
Yeah, it does have to do, there is a certain adoption component to it. Unfortunately, it slips my mind at the moment, but and again, I don't expect you guys to start reading tax code, but the tax code section that has to do with parent-child transactions under Proposition 19 is Revenue and Taxation Code 69.2. And basically that defines what constitutes a parent-child relationship. Step parents and stepchildren are among them. There is also adopted parents and children situations. And one of them does have to deal with an age restriction. So again, I apologize. I don't have that off the top of my head, but it is written in the law and
All right,
it's
thank you.
specified there.
Just real quick, we're gonna have 2 more questions and 1 Zoom question. Let's focus on the questions and speed it up.
Okay, I have a question. My sister-in-law's house destroyed by the Eaton Canyon fire.
Mhm.
So she bought the house 40 years ago. It's
Okay.
only 200,000.
Sure.
Right now, if she completely rebuild, are you going to be reassessed for that house?
No, so she has a tax base of say 300, three or
Yes.
$400,000.
Yes, around 400.
Okay, perfect. So if she rebuilds, so what's going to happen is she should file that misfortune and calamity claim if she hasn't already, the one that allows us to reduce her taxable value.
Yes.
So say we've allocated 50% of that value to the land, 50% to the improvements. What will or the actual home.
Mhm.
If she files that, we'll be able to reduce her tax base, what she pays her taxes on, to $200,000. When she rebuilds, if it's again substantially the same, she rebuilds what was there before and not more, then we'll reinstate her old tax base. So when she's done building, it'll go back to $400,000. If she takes the rebuilding process as an opportunity to expand in some way, there may be an upward adjustment for whatever additions she builds.
Okay.
Last question.
Hi, my question was if a child buys out the parents when they're still alive,
Mhm.
can they take, and they're not gonna buy it at the current value, they'll probably buy it like at what the parents purchased, which
Mhm.
was about 200,000.
Okay.
Would that child be reassessed?
Not if they apply for Proposition 19. The purchase price or if they don't apply for it, it's just like any other transfer situation where we would reassess the property at market value. If they apply for Proposition 19, it looks like they would meet all of those requirements, or sounds like it. But the one thing to keep in mind is the parents will not be able to transfer their tax base to a replacement property. So if
Mm.
they were looking to take that $200,000 tax base to another property, they're not going to be able to do both. So that may be something that they want to discuss.
Got it. Okay, thank you.
Sure thing.
All right, we got 1 last question from our Zoom friend. This is from Judy Chow. What did he meant for Prop 19 minus the 1 million.
Okay,
Yeah.
so this has to do with the parent-child transfer exclusion. So mom and dad transfer their home to their child, whether when they pass away or via a deed. So how do we determine what the child's tax base is going to be moving forward? So we look at two values. What was mom and dad's tax base before the transfer? And then what was the market value at the time of the transfer, less $1 million? Whichever of those two is greater is what the child is going to have as their tax base moving forward.
Mr. Isozaki, you are so elite and precise with your responses. I commend you for that. Now, I want you all to know that here at West San Gabriel, sometimes we pivot a little bit. So the buzzword of the day is pivot. So because I saved the best for last, I'm going to go ahead and give you his micro version of his bio, which is a very sweet bio. So Mr. Robert Isozaki started with the assessor's office in 2017 as a property assessment specialist in the legal services section. There, he addressed change in ownership issues raised through the assessment appeals process. He currently serves as a special assistant in the public affairs section, where he addresses a variety of assessment-related matters. So with that said, let's give him a really strong round of applause for that. I'm going to go ahead and thank everyone for joining our meeting today. Have a wonderful day. The meeting is now adjourned. Thank you.